Welcome to In It to Win It. This is Steve Barton, and thank you for tuning in. And thank you for allowing us to do work that we find meaningful. Thank you for giving us the most valuable commodity you have, your attention. We promise to do our very best to give you a return on it. Today we have Elliott Gue, co-founder and chief analyst at energyandincomeadvisor.com. Elliott has over 2 decades of experience in the energy sector, and today we're going to talk about oil, natural gas, uranium, and coal. Elliott, thank you for coming on the show.
Thank you very much for having me.
Yes, sir. The pleasure's all on this side of the table. Let's start out, as we always do. This is your first time on the show. Go ahead and tell us your story, how you got into the energy sector, and how that led to your advisory service.
Absolutely. Well, I actually went to graduate school in the UK, and I had a few friends who were in the petrogeology degrees and related fields. So that was the first time I kind of got interested in the oil and gas markets. When I moved back to the U.S., there was the late 90s, early 2000s. It was still very much out of favor. And in looking through the industry, I thought, we have China coming up with all this rapid growth in oil demand, rapid growth in natural gas consumption, et cetera, coal consumption. And nobody's talking about it, or not many people are talking about it. Oil was still under $50 a barrel back then, well under $50 a barrel back then. And there really wasn't a whole lot of research out there on the sector, a lot of, especially aimed at retail investors and individual investors. It was more Wall Street research and people saying, buy an ETF or buy, Exxon, right? Which isn't a bad idea, but it's certainly, there wasn't a whole lot of depth. So I started looking at this sector seriously, started attending a lot of conferences, trade shows centered on energy and commodities, related commodities. And I found there was a lot of interest in it. And, it helped that the stocks did really well at the time. So I created I created the predecessor to Energy and Income Advisor with another publishing firm I worked for at the time back in 2004. And really concentrated a lot more on energy. And it's been a wild ride, but a great ride ever since.
Awesome. Well, we look forward to picking your brain here. Let's start out with oil. And what is your macro view of the oil market as it sits today?
Okay, well, with oil, obviously there's 2 sides to the equation. There's the demand side and the supply side of the equation. The main concern for most of 2024 has been the demand side of the equation, and in particular, China. Chinese demand has been looking, quite weak all year. I think primarily that's a function of their weakening economic growth. As you know, there's been a lot of concerns about Chinese economic growth. We've been through several iterations of this stimulus trade, right, where Chinese government says or implies that they're going to try to push through some bigger stimulus, try to get the economy moving again, and then they kind of disappoint markets. So I think that's been the main problem for oil this year. On that side of the equation, demand in the U.S. has actually been pretty good. We do have weekly statistics on demand here in the U.S. from the Energy Information Administration. China, it's a little bit more difficult to come up with a real figure for what is Chinese demand, right? I tend to look at Asian refining margins. In other words, the profitability of taking a barrel of oil in Asia, in Singapore specifically, and refining it into gasoline and diesel fuel. And when that's high and rising, that's usually a sign that demand is good in Asia. Because refiners are making more money, they're being incentivized to produce more gasoline and diesel distillate fuel. And that has been pretty weak this year. I do think that we're seeing some shift there. The Chinese government did come out back in September with a more sort of big bang type stimulus plan, cutting interest rates across the board, lowering bank reserve requirements. So I think that's a potential upside risk on the demand side. The bigger issue, I think, over the next year will be, will there or won't there be a recession? If there is a recession here in the U.S. and in other major economies around the world, I think demand's going to be soft. If there isn't, I think, things could hold up reasonably well. The supply side has been an issue more recently, specifically OPEC, which I'm sure we'll talk more about today. But OPEC has a plan to increase their oil production gradually starting at the end of this year. to take back about 2.2 million barrels a day of supply reductions, what they call voluntary supply reductions that they've put in place over the last year plus. That is a concern. My general view in the short to intermediate term is that we've probably seen the low for oil, barring a major economic collapse. It's sort of a major recession over the next 6 months. And on top of that, I think that, and I think I put this one of the charts I put in the I put up there was the speculative position. The first chart there was the speculative position in the Brent oil futures market. And basically what this is it's a chart that shows the number of contracts long or short on a net basis that hedge funds and other speculators in the Brent oil futures market have on Brent oil futures and options. And what you can see here, I took this back as far as I could find data, back to 2011. You can see that at the end of September, speculators have never been more bearish on oil prices in history. And so when you combine that negative sentiment with potential upside on the demand front from Chinese stimulus, OPEC, I believe, doesn't want the price of oil to collapse, and I don't believe they're going to flood the market with oil early next year if they think demand globally is weak. I think there's probably more upside risk than downside risk with oil prices in the low 70s kind of range for WTI over the next 6 to 9 months. Longer term, I think it's a tight picture. I'm talking about over the next several years. You have rapid growth in demand from emerging markets. You have strong demand, particularly India. You have strong demand or reasonable demand in a normal economic environment from your developed countries. And I don't think there's as much supply growth out there globally as some forecasters are putting forward. In particular, I think U.S. shale production, oil production, which is crucial. The U.S. is the world's largest producer of oil, is closer to a peak than is widely thought. So I actually think that the outlook for oil over the next several years is positive.
Interesting. Okay. So a couple things to unwrap there. Basically, you think that unless we see like a worldwide global recession, we've probably found a floor in oil here around in the low 70s?
Yeah, low 70s, high 60s sort of range. If you think about it, another way to look at it is go back to and look at how oil behaved in 2001 when we had a recession here in the U.S. Most of the world was in some form of a slowdown or recession. Oil pulled back about as much as it already has from the highs back in 2022. So a normal sort of box standard recession, right? That you would see, not a major nasty recession like we saw in 2007 to 2009. I think we may have already pulled back enough to factor in that demand weakness. And then, there's so many, whenever I see speculators so bearish on oil, it doesn't take much to push oil up. It doesn't take much to prompt them to cover those short positions. Geopolitical risks, Chinese stimulus, some sign of slowing U.S. oil production. Any of those things could be upside catalysts. So I just think that the risks are really skewed to the upside.
Okay. That's good news if you're betting on oil. Okay, and you mentioned shale. So
Yes.
the shale boom, maybe give us a 101 on that, on what a game changer that was for the oil and gas sector.
Well, it was enormous. When I first started analyzing the energy markets in, say, the mid 2000s and started writing my service focused on the industry back then, there was a culture of there not being enough energy in the U.S. and we were going to have to import more energy into the U.S. We're going to have to import. If you remember back then, a lot of people were talking about the quantity of natural gas that the United States was going to have to import. And we went from a culture of not enough energy, not enough commodities to a sort of a glut in the space of about 5 to 7 years, literally. And really, if you look back at U.S. oil production in the 2008, 2009, 2010 timeframe, at the beginning of the shale boom, it took off. And we were seeing, U.S. oil production growing 1.5 million barrels a day in some of those years in the mid 2010s sort of time frame, 2013, 2014, particularly in that 1.5 million barrel a day growth in U.S. oil production. And remember, U.S. oil production at one point was less than 5 million barrels a day. So that's tremendous. And what we saw then was that it became a problem for OPEC and Saudi Arabia in particular. And in 2014, what they'd been doing from roughly 2011 through 2013, early 2014, U.S. oil production was growing very rapidly. It was growing faster than demand, global demand. So there was downward pressure on the price of oil. To prevent it from falling, maintain oil prices around 100, the Saudis were, and the rest of OPEC, but let's face it, that's mainly the Kingdom of Saudi Arabia, was pulling back on their own production to prop up the price of oil. But every time they did that, the U.S. just produced more oil. And production growth was so rapid, the Saudis began to realize in 2013 and talk about the fact that they were essentially financing the shale boom, right? By maintaining oil prices artificially high, they were encouraging all this growth in U.S. oil production. And that's when they flooded the market in late 2014. And we saw that long bear market in oil, which really didn't end until 2020. And so, it's been a game changer for the industry. And we saw very rapid growth in the early years of the shale boom. What I think the key shift has been in, say, the last 4 or 5 years has been a change in the shale industry maturity level, if you will, right? Back in the heyday, right, the boom years, it was a lot of little producers in places like the Permian. They were totally focused on volume growth, more barrels of oil equivalent and oil coming out of the ground in places like the Permian. And that's how they got their stocks to go up. If you do, I used to do this back in 2013 or so. If you charted the total return on a E&P, a producer stock, versus the growth in their production over, say, a trailing 3-year basis, you'd see an almost perfect correlation. The faster they grew production, the higher their stock was valued, right? And that's changed. Increasingly nowadays, shale production in the United States is in the hands of a few large independent producers and the majors, right? So Exxon, Chevron, names like Occidental, very large independents. And they're much more disciplined. They're not looking to grow barrels out of the ground. They're looking to grow free cash flow. And that's how they've always operated. You look at Exxon, when they start up a new oil project anywhere in the world, what do? They pour a ton of capital in, get production up to a plateau, and try to sustain that plateau for as many years as possible. They focus on being able to produce oil profitably at a low price of oil. So for them, that's in the 30s somewhere a barrel. And they don't change their production plans because the price of oil goes up $20 over a 12-month period or down $20 over a 12-month period. They're focused solely on maintaining a low price of oil and then through the cycle generating strong free cash flow. And so what that means is that shale production growth is unlikely to ever get back to what we saw back in 2012, 2013, 2014, because the producers, they're not chasing commodity prices. And that's one of the reasons I believe concerns about OPEC flooding the market again this year. We've heard talk about that. There was an FT article, Financial Times article in the UK out a week or two ago. And the problem with that is that they're not really facing the same issues they were in 2014. The big producers in shale are not going to grow their production much faster, whether the price of oil is at $100 a barrel or $70 a barrel. They're focused on this disciplined, low-cost growth over time. And so there are two sides to that coin. One is that I don't think OPEC is particularly concerned about market share over the intermediate term. They're not going to try to push the price of oil down because that's not really going to squeeze out much shale production as it did back in 2014, 2015. The second side of the story is that some of the organizations out there that are putting out longer term forecasts for oil, they're penciling in pretty strong growth from the U.S. And I don't think that's going to happen. I think you're going to see at best, very gradual growth in U.S. oil production. And I think we're nearing, in the next few years, say within three years or so, we're nearing a sort of peak plateau for U.S. shale production. Doesn't necessarily mean it's going to plummet, but I think we're going to see a steady sort of level of production over a period of years, not any kind of growth like we've seen in the past.
Okay,
And
yeah,
that's
because
bullish for oil.
yeah, if I understand this right, shale is a little bit more of a kind of a quick get it, right? They drill
Yes.
down, they pull out a lot, and then it's kind of depleted, and they got to go find another spot. Is that correct? Or
Basically, I liken shale. Shale is more like a manufacturing business, whereas conventional oil development is different. With shale, it's really about you can produce more if you can drill faster, right?
yeah,
So, and you're running on a treadmill. So let's say you have a certain amount of acreage in, say, the Permian Basin or another high-end play like that. That's the most important play in the U.S. You have prime acreage in the heart of the Permian Basin. You pretty much know how much oil is going to flow out of any given well. There's not a whole lot of exploration risk. The oil is widely distributed through the area. And so your focus is just on establishing a drilling design for your wells, right? How long are they? How deep are they? How many stages of fracturing do you do? How much sand do you put in to the well? Things like that. Once you establish that sort of baseline, it really becomes a manufacturing business. Go out, drill more pads, drill more wells, produce more oil. If you want to grow production, you have to not only drill enough wells to produce more oil, but you also have to drill enough wells to offset decline from your existing wells. Shale decline rates are very high. It depends upon where you're drilling, but they can be as high as 70% in some of these plays in the first year.
oh wow,
Which means that your initial production rate will decline 50 to 70% in that first year of production, depending upon whether you're targeting oil or gas and what play you're in. So it is, you're on a treadmill. You're having to run a certain speed just to prevent from falling off the back, from seeing an outright decline in production. And then if you want to gain ground, you have to run faster and drill more aggressively and pour more capital into it. But it is more of a manufacturing business than, say, the conventional business where it's out about go out, explore find big accumulations of hydrocarbons, determine whether it's feasible at a certain price of oil and gas to drill those wells, and then you drill a bunch of wells, and then you essentially have a production curve. It grows to a level and then plateaus for a number of years. That's not how shale works. It's much more of you're deciding quarter to quarter, year to year, how much do you want to spend in capital? How many wells can you drill with that capital? And what does that mean in terms of your production growth? And the key shift we've seen in that is that in the olden days, if you will, of the early years of the shale boom, it was about how much capital do we have to spend to grow production 10, 20% in a year? Now it's more about, okay, if we spend $2 billion in capital in a year, and oil prices are at, say, 60, what does that translate in terms of free cash flow? And if the price drops to 50, we can cut our CapEx, allow production to fall a little bit, and enhance our free cash flow. If the price is a little higher, we push up our capital a little bit, grow 2-3%, right? And increase our free cash flow. That's the calculation. It's a financial calculation, not a volume calculation nowadays.
okay, interesting. Okay, you briefly hit on OPEC.
Yes,
Maybe give us a brief overview of it. The heavy hitter is Saudi Arabia.
correct.
What countries are in it? How significant is OPEC's role today in controlling the oil supply? Like, what's their share of global supply? And has their influence increased or diminished over the last decade or so?
Yeah, a lot of complicated questions in there, but I'll try. Yeah, it's I mean, OPEC was formed in the 60s, but it really started to flex its muscles in the early mid 1970s, when it found that by restricting production, they could influence the price of oil in a big way. And that's really why we had that very rapid growth or inflation in commodity prices and oil prices back in the 1970s. Today, OPEC, right now, they're producing the big 12, if you will, OPEC countries. So they're going to be countries I mean, there are countries all over the world in OPEC. You have the Middle East, of course, you have Africa, countries like Nigeria, and you have South America, countries like Venezuela. But the really important countries are going to be, Saudi Arabia, which is currently producing a little under 9 million barrels of oil a day, but is capable of producing probably 12 million, maybe
Oh, wow.
12 and a half million barrels a day. So they're purposely keeping oil off the market to prop the price up. That's called spare capacity. You have Iraq, right? Iraq is another major producer in OPEC. You have I think around a little over 4 million barrels a day right now. You have the United Arab Emirates, right? Is another major longstanding producer that's important because they have generally been reliable in terms of when they say they're going to cut production to prop up the price, they do so. And then, a lot of the countries, I don't want to say they don't matter, but they kind of don't matter. Nigeria, they're producing mainly the reason they produce what they produce is because that's all they're capable of producing. They may claim they have a higher capacity, but they haven't been able to produce at that level for many years. So saying they've cut or not cut production, it's kind of meaningless. Maybe a few tens of thousands of barrels a day, but nothing in the context of 100 million barrel a day plus global oil market. The countries that really matter within OPEC itself are going to be Saudi Arabia and a few others like Iraq and UAE. And Saudi Arabia is by far the most important because they're the only one that has really proven decade after decade, literally, that they are willing and able to push production up and down to try to influence the price of oil. And they follow through on it. Outside of OPEC, you have these so-called OPEC plus countries as well. This is a relatively modern development. 2019, 2020, that started getting off. And the biggest country there would be Russia, right? Russia is capable of producing over 10 million barrels of oil a day. They're producing a bit less than that right now, more like 9 million. So in line with Saudi Arabia. So overall, right now, the OPEC 12 is producing around 26 or 27 million barrels of oil a day. They have in the past produced 30 plus million, which, in the context of a 100 plus million barrel oil market, about 30%. So they're still a huge chunk of global demand. But what makes them punch above their weight is that most companies in most countries make decisions based on their production, based on the economics, right? If they can produce more oil and make more money, they do so. If they can't, they cut back, right? It's purely an economic decision. With OPEC, they're the only ones that are out there literally saying we're going to cut production by a certain amount, cutting it to push up the price of oil and prevent global oil storage inventories from rising. And so that gives them a lot of power. Saudi Arabia in particular, because Saudi Arabia, they have all that spare capacity, which it's very expensive for them to maintain all that. They have all that oil they could produce but don't, and that gives them an implied threat, if you will, to the rest of the cartel. They say, hey, if you keep producing more than you agreed to produce, we'll pump more oil, crash the price of oil, and it'll hurt you more than it hurts us. And we can afford it, right? That's kind of the way they are able to control the global oil market because they have that implied threat. So they're very important. I would say throughout history, every cycle in oil, up and down, is a function of supply and demand, right? But some cycles are led more by demand and other cycles are led more by supply. The 1970s was a classic supply cycle. The price of oil demand continued to rise through the 70s, but the big change was that OPEC wasn't supplying oil as freely. Therefore, there wasn't enough supply to meet demand. So the price of oil went up. Supply-led cycles are sticky because it's harder to adjust supply than adjust demand. If there's a recession, demand goes down. It really is that simple. When the economy recovers, demand goes right back up. We've seen it over and over again. Supply-led cycles like 2008. Price of oil was $150 a barrel, right? In July 2008, it's in the 30s by the end of the year. 2 years later, it's back up over 100. okay? They're V-shaped because demand comes bouncing back the second the global economy recovers. Supply cycles, it takes time for producers to go out, develop more wells, or find and explore for new fields and produce more oil. It takes longer for supply to adjust than demand. Now, OPEC has a harder time addressing supply shocks than demand shocks. When the global economy goes into recession, they usually cut production because they don't want to sell oil. They don't want to sell so much supply in a down market that global inventories build because it prolongs the eventual recovery in prices. The other thing is, why sell oil at $30 a barrel in late December 2008 when you know that, a year from then, the economy is likely to recover, demand's going to be higher, and you can probably sell it for 70 or 80, right? So they're perfectly willing to cut production and help support the market when there's demand is the problem. When supply is a problem, like in 2014, it's this growth in US shale that they can't control. It's harder for them to control prices because if they cut production to prop up the price, it'll work, but they're going to lose market share, right?
Yeah.
So their power is less. They have very hard choices when it's a supply-led cycle, down cycle. They can cut production and keep the price of oil high and accept lower market share, or they can flood the market with oil, drop the price, and hope that that squeezes some of the higher cost producers out of the market and alleviate supply problems. But it takes years. It took 4 or 5 years after 2014 for that to actually have an impact for the Saudis flooding the global market. So they're very powerful, but you have to understand the root cause of price moves in the oil market. Is it demand that's the problem? They have a lot of power to influence prices and a lot of willingness to do so. If it's a supply-led problem, then OPEC really has hard choices and has a hard time controlling the market.
Okay. So what's the total, how many million barrels a day does the world consume? You said 100?
A little over 100. It depends on how you, if you look at it on a pure oil basis, it's a little over 100. If you include some very close to oil-like products like condensate and some natural gas liquids, which are heavier natural gas liquids, is more like 103 or 104 million barrels a day.
Okay. And OPEC provides 40% of that?
Currently 27 million barrels a day, roughly. Their peak, though, is more than 30 million barrels a day. So they're close to 30% of the global oil market, and that doesn't include the plus countries.
Okay.
Like
What is
Russia.
OPEC plus countries, is it?
OPEC plus would include includes a number of other countries. The most important is Russia, though. Russia alone accounts for another 9 or 10 million barrels of oil a day. And in fact, if we look at the 3 biggest oil producers in the world are Saudi Arabia, which produces around 9 now, but is capable of 12.
Well,
The United States, which is sort of that 13 million, a little over 13 million range, the largest, and Russia around, let's call it 9 to 10, right? So those 3 countries account for, well north of 30 million barrels a day. And one of those countries is in OPEC, Saudi Arabia. One of them is in OPEC plus, which is Russia, and then of course the United States is not in either one. But yeah, so they do have a large portion of global supply. If you look at the core OPEC, it's around 30%, I would say, on a capacity basis. If you look at plus, I mean, you're looking at more than 40% of the global oil market. They control more than 40% of global supply. And then the rest of it would be your non-OPEC countries, which are, in various different strategies towards the oil market. The U.S., of course, as we discussed, is the most important of those. You have other large producers out there like Canada, which, Canada and the U.S. are North America as a whole is a very important oil production center. And then you have some sort of upstarts, if you will, some countries that don't have that much production today, but are expected to see significant production growth. Guyana in South America is a classic example. Exxon has a major production project there on what's called the Stabroek block. I probably butchered that. It's Dutch, but they made the initial discovery there in 2015. And I believe Guyana last year produced something like 400,000 barrels a day. But in the next few years, I mean, that's going to grow to over 2 million in the next
Oh,
5 years. So that's an important growth center. Brazil is another one. Brazil has quite a bit of production already, but they're also adding a lot of capacity. And neither one of those countries is in OPEC at this time. And I don't think they'll join. Yeah, OPEC, though, is still important, not only because of the total amount of oil they produce, but their willingness to change their supply in response to global price conditions.
okay. All righty. Let's do a quick overview of Brent versus WTI. Can you give us
Sure.
kind of a 101 on that?
Okay, sure. West Texas Intermediate, or WTI, is the U.S. oil benchmark. It's the most widely quoted U.S. oil benchmark. It is also the grade of oil which underlies oil futures here in the U.S. So if you trade oil on, on NYMEX, that is delivered by WTI to Cushing, Oklahoma. Now, Cushing, Oklahoma is a landlocked oil terminal in Oklahoma, in the state of Oklahoma. It's not on the coast. That can be important, as I'll get to in a moment. Brent is the key global benchmark. The Brent is named after the Brent oil field, which is located in the UK sector of the North Sea, northern Scotland. And that oil is for delivery to a place called Sullom Voe, which is actually an oil terminal in the Shetland Islands, which are in far northern Scotland. It's very cold up there. That's the key global benchmark. So typically in recent years, your Brent oil is going to trade at about a $4 to $5 a barrel premium to West Texas Intermediate delivered to Cushing. There are a number of reasons for that, but the two most important, I would say, is that, first of all, as I said, Cushing is in Oklahoma, so it's landlocked. It's not on the coast. Wasn't a big deal when the U.S. was primarily a consuming country, but now we're an important exporter as well. So oil on the U.S. Gulf Coast, Louisiana, Texas, typically does trade at a premium to WTI and Cushing. For example, LLS, Louisiana Light Sweet Crude Oil, which is obviously delivered to Louisiana, Gulf Coast, trades at a $2 or $3 barrel premium to West Texas Intermediate at Cushing. So part of the discount you see Brent trading at a premium to WTI is just that the WTI benchmark we most often follow is price for delivery to a landlocked place, right? Which is Cushing, Oklahoma. The second aspect of that is that the Brent oil market is going to tend to reflect global supply and demand conditions mainly, whereas WTI is going to reflect more your U.S. supply and demand conditions. So U.S. supply growth has been strong, as we talked about, from shale in recent years, particularly in Texas, right? And a lot of that oil in Texas ends up in Oklahoma at Cushing or on the Texas Gulf Coast. So the supply in the Cushing area, in the WTI areas, right? Whether it's Midland in West Texas or Cushing in Oklahoma, or even the US Gulf Coast, supply has been relatively loose compared to supply in Europe, which is increasingly an import-driven market, or certainly, compared to, say, Asia. So they're very similar grades of crude. They're both what we call light sweet crude oil. Light means easier to refine, basically. Sweet means it doesn't contain a lot of sulfur. So both Brent and WTI are very similar light sweet crude oils. In fact, because we've actually run out of Brent oil, right? That field is no longer an oil field. They don't produce much oil at all, really, from that region of the North Sea. They actually use in that benchmark to deliver against that benchmark. They actually have included some U.S. oil in that mix, right? So you could actually literally be the same oil. It's more about where it's delivered, right, than the quality of the oil itself. And for that reason, the global market's been tighter, and it's more of a sea-based crude oil market. The U.S. market, WTI is an inland oil benchmark, and it's also in an area where we've seen very strong production growth. It does tend to trade at a discount.
Okay. Yeah, that's one of the, I'm kind of a trader, so looking at it on the charts, yeah, it's always a few bucks more
Yeah.
than WTI. Okay.
The
So
only time
W
you'll see that not be the case, sometimes, if there's, for example, a hurricane comes and takes out oil-related infrastructure or something unique to the U.S., but almost always it's going to be traded at a premium.
Okay. Okay. Um, and let's go on to, okay, so recent news with the ongoing geopolitical tensions in the Middle East. How do you see these conflicts impacting global oil prices? You know, it's not great when you have missiles flying around
Oh.
shipping lanes. Any updates on the Middle East?
Well, what I would say about it generally is that my inclination is to fade um, geopolitics-driven moves in oil. I'll give you a few examples. If you remember back in 2019, the Houthis in Yemen attacked Saudi oil infrastructure. And Saudi Arabia, as I said, is probably, I'd argue, the world's most important producer, not because it's the largest, but because it's the only one that's willing to change its production, right? As we talked about. And they attacked Saudi oil infrastructure directly. And it caused a spike in oil. That spike faded within days. Huge spike in oil, if you remember. I think oil was up, $7 or $8 a barrel in, an hour. But within days, it was right back below where, by the end of that month, it was back below where it started prior to those attacks. And the reason is that generally geopolitics-driven spikes will cause a big move in oil prices, but they haven't historically had a huge or lasting impact on global oil supply. So if oil were already positively disposed in an uptrend, demand supply conditions look pretty tight, then geopolitics driven spikes can sort of accelerate the move. That's kind of what we saw with Russia back in the Ukraine-Russia conflict back in 2020, 2022, the start of 2022. We saw that big move higher, but that was already reinforcing, oil was already in an uptrend. It already looked tight, and that just kind of accelerated things. But if oil is bearish, if the market looks loose, then geopolitics-driven spikes will typically cause a very short-lived move higher, followed by a decline. I would say that's likely to be the case this time. Now, there is a risk because, because Iran is involved, right? For example, if Iranian oil infrastructure were damaged such that, they would have to, that could take 3 million plus barrels of oil off the global market. Obviously, that would have a more real impact on oil supply and demand balance. Traditionally, though, it's unlikely to happen. It's more of like a worry in the back of traders' minds. Now, in this case, though, I would say that one very, very important element to look at is that first chart that we threw up there about the Brent oil speculative position, right? You have a lot of speculators who are short oil. Now, if I were short oil, especially ahead of a weekend where something could blow up, that's not a very comfortable place to be.
Yeah.
So I think it probably makes people more likely not to get more short of oil with this going on. And so I think that's another, it's not really a hard floor on oil, but I think that's more of a support for oil near recent lows in the short term. So that's the way I would look at it. I actually think that by the middle of next year, I mean, if the global economy isn't in recession, I think the supply demand balance for oil is going to be a lot tighter than most people think. And, again, it could just be something that sort of accelerates the upside. But for now, I think it's an important support given the speculative position in the oil market. If everybody were already long of oil, so like we saw back in early 2018, right, then it wouldn't matter, right? So as much. But when you've got a lot of shorts in the market, that's a very uncomfortable place for a fund to be short of oil with, the potential for something really bad to happen, especially when the market's closed, right, over the
Okay.
weekends.
Yeah. Okay. So usually these things cause little intermediate spikes, but they don't interrupt the
Right.
long-term trend, whether that's gradually up or gradually down.
Right. I kind of, in many ways, I don't like it to hear that is the main driver of the oil market because the market can overreact to it in the short term, and then usually the moves fade away. like we saw back in 2019. In this case, though, I think with the size of that speculative short position and that bearishness in the futures market, I don't think that people are going to be willing to go too short of oil in that situation. And so again, that's another sort of support for oil.
Okay. All right. Impact of electric vehicles on oil. With the rise of electric vehicles and global sustainability goals, what do you foresee as the long-term impact of EVs on the oil market?
Okay. In the long term, I do think it will have an impact, but in the short term, I think that it's overestimated in the short to intermediate term, the impact that it's actually going to have. And I think actually the third chart that we have in that slide deck of the Norwegian market is kind of instructive here. Many of you may have heard that the Norwegian market has got a very high EV share, a market share. So this chart actually shows from 2009 to 2023, the share of the Norwegian new car registrations
There we
that
go. Now
are
you can see
either,
it. Sorry.
yeah, it's right there,
Okay.
right there. Hopefully, yeah, hopefully you all can see. I'll speak about it anyway. But yeah, and the blue part of those bars is actually the share of the Norwegian oil market that is battery electric vehicles. So that's your pure electric cars. And that little orange bar is actually your plug-in hybrid electric vehicle. So these are cars that have an electric engine, but also have a sort of gasoline backup or diesel backup engine, right? So you can see that in 2009, only 0.11% of Norwegian car registrations were either battery electric vehicles or plug-in hybrids. In 2023, it was 89.9%. Okay, so very, very rapid growth in EVs in Norway. And you've probably seen this. I see it all the time on Twitter or X, it's now called, right? People say, oh, well, look at the Norwegians. They have 90% electric vehicle market penetration. When the U.S. gets there, oil demand's going to collapse, right? Is usually some version of the narrative. But look at that, 0.11% in 2009. We saw 50%, a little over 53% in 2019, 2023, almost 90%. Next year, 2025, they're going to ban the sale of new electric or new diesel and gasoline powered cars. Now that black line that you see there is Norwegian oil consumption in barrels of oil per day. In 2009, it was 213,580 or so barrels a day, right, of oil. Last year in 2023, it was 213,300 and some. So you've literally seen less than 200,000 barrels a day, decline, or sorry, less than 20,000 barrels a day decline in Norwegian oil consumption, even though electric vehicle market share has gone from 0.1% to almost 90% between 2009 and 2023. And look at that black line. I mean, it's almost entirely flat over this period. And it's not a short time frame. It's, it's all the way from 2009 to 2023. And if you look at it, you'll see that, there in the middle of that chart from 2014 to 2020 or so, we saw EV penetration grow particularly rapidly.
Yeah.
But oil demand was actually up a little bit over that time frame, right?
Yeah.
And 2020 was the peak for Norwegian oil demand, but remember that was mainly an economic scenario. The global economy was 2019 was the peak, and that was mainly because the economy was doing relatively well globally. And in 2020 we saw that big decline. That was more driven by lockdowns, travel restrictions, etc., than electric vehicles. So I think the lesson here is that and of course, the United States has EV market share nowhere near what Norway does. No country in the world has an electric vehicle market share anything approaching Norway's, right? So even if we were to get to a very high EV penetration, right, sort of 70, 80, 90%, it doesn't have as much of an impact on oil demand as most people think it will. And there are, obviously you might think, well, how can that possibly be the case, right? Well, there are two things at work. First of all, you got to remember that people don't replace their car annually, right? So the new car sales are a small portion of total car sales. Here in the US, I believe the average age of an automobile on the road is around 11 or 12 years at this time, which is
Yeah.
actually a high for many, many years in the past. And, there are hundreds of millions of cars on the road, new car sales are a tiny fraction of that in any given year, even in a good year for new car sales. So it takes time. So even if you have a lot of new EVs hitting the roads in a given year, it takes time for those old cars to be retired, and therefore to be off the road. Now that is actually a little faster process in a country like Norway than it is in the United States, because Norway has more stringent requirements for fuel efficiency on existing cars on the road, but it still takes time. The second factor is, and I think this is the more important one, is that passenger car demand globally only accounts for about 25% of demand for oil globally. The
Oh,
rest is going to be, commercial transportation, trucks, trains running on diesel, ships running on bunker fuel, right? Which are
airplanes.
much, much harder to replace with electric vehicles, practically due to weight concerns, due to cost, right? Due to the size of batteries needed than passenger cars. And then the other thing you have is petrochemical production. Most plastics are made from oil-derived products, for example. So it's not so simple as saying, okay, if we mandate that all new car sales be EVs, we're going to see oil demand drop to zero, in 5 years. That's not the way it works. Even in countries which have been very aggressive promoting EVs, using, the carrot and the stick approach, right? Using both tax incentives, free tolls, as they have in Norway, but also putting a tax, a surcharge on gasoline and diesel powered cars, ICE, internal combustion engine cars, I should call them. It takes a long time for it to have any discernible impact on oil demand. So I think that we will see it, but I think that it's more of a literally, I would say, 20 plus year time frame to see before we see peak oil demand globally from this kind of replacement. Than it is something that's going to happen in the next 5 or 10 years. So it is happening, and I think we're going to continue to see electrification globally of a lot of different things. But oil isn't going anywhere, isn't going away anytime soon. The other thing I think you have to consider is, where is global oil growth coming from? Where is global oil demand growth coming from? It's not coming from the United States. It's coming from India, right? India consumed about 5.5 million barrels of oil a day last year. That is growing at around 4 or 5% annually. The Indian economy is outperforming the Chinese economy. We saw Chinese oil demand reach 5 million barrels of oil a day. I think it was back in 2002, 2003 at that time frame, and it went parabolic, right? Became the second largest oil consumer in the world, 15, 16 million barrels a day of oil demand now. The fact is that when a country gets to a certain level of development, people start using more energy. I actually wrote a book on this where I had a number of chapters on this issue back in 2005. And we've seen it in a lot of countries around the world. Go back and look at Japan, right? In the 50s and 60s. The economy started growing very rapidly, and energy demand per capita went parabolic. People started getting appliances, started getting automobiles, started using more energy. Korea, maybe 10 years after Japan really started to take off, we saw that very rapid growth. More recently, China, now India. So in countries like that, it's going to take a lot longer for electric vehicles to reach high levels of market penetration as they have in the US or Norway, right, or Europe. So I think it's going to actually take a lot longer than some organizations out there like IEA, International Energy Agency, are saying, global oil demand is going to peak in 5 years. I mean, they've said that before, but I think it's wrong again. I think that it's going to take a lot longer than that. And it's going to be more of slowing growth and then a longer plateau and then a gradual decline. I don't think it's a disruptive change in the next, 15 or 20 years at least.
Okay, that's really interesting because when you think about, or at least I did before you showed me that chart, that you know most oil consumption doesn't necessarily come from vehicles. But
Right.
that's the first thing you think of because everyone has to go to
Yes.
the gas pump.
Right. We see it every week, right? We, fill, or every month you fill up your car and you see it, right? That's you're using oil. But the reality is that, more of it is used in other things than in, passenger cars. And, and a big part of that is, for example, commercial trucks. It's very difficult to use an electric engine in, say, an 18-wheeler, right?
Yeah.
The current technology isn't sufficient. Current battery technology isn't sufficient. Doesn't mean that won't change in the future, but we're a long way from there.
Yeah, yeah. I talked to a guy in the industry, and I think he said somewhere between half to three-quarters of the trailer would have to be batteries for them to go
Right.
several hundred miles. So it's just it would be completely inefficient.
Right, right. And the cost of everything would go up as a result, right? So yeah, it's going to be a long time in coming, I think.
Okay, okay. All right, JV, a listener has a question. He said, "Are you more bullish towards Canadian oil companies or American oil companies?"
Yeah, I'm sort of location agnostic, if you will. I'm willing to go to anywhere where I see an opportunity. And right now, I would say that in my coverage universe, I probably follow the U.S. based companies a little bit more closely on the oil and gas side. I've followed the Canadian companies for a number of years, and my colleague at my company, Roger Conrad, some of you may have heard of him, he's followed the Canadian companies particularly closely for many years. Um, so I'm agnostic on locations. I will, look at a company based anywhere. I would say right now, because the oil market and the gas market is a little bit more squishy, if you will. Prices are down. As I said, I think there's more upside risk than downside risk, but energy stocks have been very volatile, as any of you who invest in them know. So I'm tending to focus more on larger companies, and a lot of them are based in the U.S. I'm talking about names even like Exxon, right? So I would say right now I'm probably a little more focused on Americans, but it's not has nothing to do with where the company's located. It's more about um, just what I see in the very short term. And again, I mean, if I thought in the past, I've thought there were better opportunities in Canada, and we've put a lot more Canadian companies onto our recommended list. We have several right now, mainly on the midstream side, but we have several Canadian energy companies in our model portfolio right now. But right now we're a little bit more focused on the U.S.
Okay. Okay. He has a follow-up question, and Taskeen also wants to know about your opinion on Canadian natural resources.
Yeah, CNQ. Yeah, they're an interesting name. I actually like that stock right now. I think that they're making a nice pivot in favor of oil here in the second half of 2024, and away from gas, which I think is the right move for them at this time. I think they've been really disciplined on their costs. They've gotten their debt down, which is something I'm looking at very carefully. How much debt do companies have? So I think CNQ is a good name to own right now. And not the most exciting production growth, right, in terms of speed. But again, right now I kind of like those bigger companies that are kind of steady, relatively low debt, because we aren't in a roaring bull market, right? Especially for gas. Oil, but the North American gas has been a troublesome area. So, I like those companies that are doing more organic things, managing around the edges in terms of shifting their production from gas to oil, rather than companies that are farther out on the risk curve, that are looking at more rapid growth, but are also, having to take on more debt or take on more risks as smaller companies. So I think CNQ is a pretty good place right now, actually.
Okay. Okay. Patrick wants to know. He says, in terms of valuations in the oil and gas sector, should
Mhm.
investors focus on producers, royalty companies, or oil service companies?
Okay. So in a normal oil upcycle, where you have demand basically exceeding supply, prices going up, right? In the sort of middle stages and latter stages of that is when the services companies really shine. Doesn't mean you can't make money in the services companies earlier on, but you got to remember that the first companies to benefit from rising commodity prices are producers, because they're actually pulling oil out or gas out of the ground and selling it on. So their revenue is directly tied to commodity prices. Services companies, their revenue is the capital spending from the producers, right? Yeah. So in order for them to make more money, you have to see spending on the part of those producers rise, which typically happens only a few years after their own revenues start to rise. So for example, if I'm a US oil company and gas prices are at 4 and I'm increasing my capital spending to produce more natural gas, companies that sell services to me or equipment to me are going to benefit from that. But if with gas at 250 and I'm cutting my capex to preserve free cash flow, it's a different equation. So I would say that generally speaking, at this stage of the cycle where prices are relatively low, I think we're generally going to head higher. I would say particularly on the gas side over the next year and a half or so. I do think that's going to really benefit the producers most of all. Services companies, right now, I like services companies. I'll give you two names actually, just to give you an idea. But the company that was formerly known as Schlumberger, and for some reason changed its name to SLB, which I still misquote pretty much all the time. So pardon me if I refer to it as Schlumberger, but most of their revenue comes from countries outside North America. And that is where I see a lot more spending growth over the next few years. Deep water, places like the Middle East. And they're been operating there for decades. They know how to operate in a country like Saudi Arabia. They have the technical expertise to do that. Right now, the stock is actually, it's actually pretty depressed. And I think over a intermediate to long term, that's a good name to own on the services side. I'd also look at a name like Baker Hughes, symbol there BKR. What I like about them is they're focused on liquefied natural gas. They have a lot of exposure to the liquefied natural gas business. In particular, their equipment is in almost virtually all liquefied natural gas plants around the world. I think that's a growing area. I think we're going to see trade in natural gas really pick up over the next several years. I think natural gas is key to the global energy scene. It's going to be a major source of electricity generation growth in coming years. And we can talk about that more, I'm sure, later on. But I like BKR because of their exposure to that theme. What I would avoid is any oil services companies right now that are focused more on North America, particularly smaller ones. The problem being is that until oil and gas prices really, particularly gas prices, start to pick up, I think you're going to see most of those companies focused on keeping their capex down, capital efficiency, not spending more. And that's going to kind of put a lid on their revenue. So I would say generally the producers is where I would look. We do have a few royalty companies in our model portfolios. And oil services, I would stick offshore and overseas right now, if you will, outside North America, and preferably a lot of deep water exposure or themes like liquefied natural gas. And then I would avoid some of the US or Canadian-based, especially smaller services names.
Okay, that's interesting. That kind of reminds me of the cycle of investing in, I'm just going to gold because I know it, but you
Yeah,
start with the physical metal itself, and then you move into the big majors, like Agnico Eagle, and then as the cycle kind of gets toward the end, you might be able to capture some real alpha in the juniors. And it
I
sounds
think
like you're
I
saying,
think that's a very apt metaphor, because it's exactly the same. In the early stages, I would start with the big names on the producer side. And then, as time goes on, you can move down the cap scale and, and to sort of more out the risk curve in terms of locations and production costs and things of that nature.
okay, okay. And do you follow Blackstone or Freehold at all?
I do follow Blackstone. In fact, that's one of the royalty names that we have in the BSM in our model portfolio. I think that over the intermediate term, that's going to be a good place to be. I think they've got good royalty positions in the core shale basins around the U.S., particularly the Permian area, some of the gas plays as well. So I think that's a name we have liked. Um, they've got a nice yield, of course, which attracts a lot of people. We have it as a more aggressive pick because of that. The stock can be very volatile, very sensitive to commodity prices, and they have had to cut their payout a little bit, right? When the commodity prices are down. And that spooks a lot of investors. But I think over the long term, that's a good name. Just be aware that it's going to be a little bit more aggressive and a little bit more volatile.
Okay. I found it's really, it's a lot of fun for options.
Yeah. You can actually do well with options on because the implied volatility on a lot of these names is sort of sky high. So.
Yeah. Okay. Bonus question, Patrick. Do you follow Source Rock Royalties?
I took a little look at it. It's a little lower in terms of capitalization than we generally would look at. I'm a little concerned about their. It's just a little smaller than we would generally cover. So we don't cover it. I've followed in the past, but I can't say that I know enough about it to be able to give you a particularly satisfactory answer on that one.
Okay, that's an authentic answer. Okay, moving on to natural gas.
Yeah.
Macro view of natural gas, it plays a crucial role in the energy mix.
Yeah.
What's your macro view on natural gas? Any headwinds, tailwinds you see?
Okay. Well, first of all, you kind of have to divide it up between the North America and the rest of the world because prices are very different.
Yeah.
In North America, prices right now are very depressed. The reason for that is mainly we had a very warm winter last year. Heating demand is still crucial to the U.S. and the North American gas market, but particularly the U.S., right? And we had a very warm winter. So inventories of gas, storage levels of gas are still well above normal. I think that it's gradually healing for two reasons. One of them is, demand over the summer was pretty decent. Power burn for gas was pretty decent. But more importantly, right? And also I would say that we're entering La Nina period here in the south in the Pacific current, ocean current. A cooler current tends to result in winters that are less likely to be above average temperature wise. So I think that bodes well for demand this winter relative to what we saw last year. I mean, I can't predict the weather. Wish I could with 100% foresight, especially right now with a hurricane here in Florida. But I think that the probability suggests that you can probably pencil in a more average winter than we had last year. So that's positive for demand. Supply, though, is absolutely crucial for gas. And what we've seen is good supply discipline from the major producers of natural gas in the U.S. You look at names like Chesapeake Energy, which has now renamed itself a couple days ago to Expand Energy.
Oh, I didn't hear
You have EQT in Appalachia. You have some smaller names too, Comstock in the Haynesville. And two plays in particular I would look at. The Marcellus, which is in Appalachia, Pennsylvania, Ohio, places like that. And then the Haynesville Shale, which is centered in Louisiana. These are the two most important gas-focused plays in the U.S. I'm not talking about gas that comes out of the Permian Basin, that's associated gas that's naturally occurs with oil. But your pure play gas basins, Appalachia and Haynesville, are the two most important. And you've seen good production discipline there. Companies deferring well completions, also doing what we call deferred tills, right? Turn in lines. So turn in line is basically the last stage. You drill a well, you complete the well, you fracture the well, and you're ready to put it into production, but you don't actually put it into production. So it's basically like the keys are in the ignition and you just walk away and wait for higher gas prices. So by not putting those wells in production, they're not pushing gas into a market that's already oversupplied. DUCs, or deferred uncompleted wells, are wells that you've drilled, but you haven't fractured and prepared for production. These producers are doing both of those things. And they're also cutting their capital spending and drilling fewer wells. As a result, we're seeing production in the Haynesville decline pretty rapidly. The Haynesville in Louisiana is a little bit more expensive to produce gas, Most producers there need upwards of three, sort of 325, 350 a million BTUs to make good money out of decent free cash flow out of their wells. We're seeing production there drop rapidly. In the Appalachia, it's been a little bit slower, but wells there, some of them break even under two. So $2 a million BTUs. So, but we are seeing production come down. So you have declining production. You have demand about to pick up here in a few weeks' time as winter heating picks up. You have the excess inventory has already been cut by more than 50% relative to the 5-year average. So you're starting to see a bottom on gas on the front month. The other point I'd bring up, and I think this is actually the last slide I have on this slide deck. I'm sorry to jump around on these slides
you're
so
good.
much, but I think it's important to understand how gas is priced in the United States. When you hear people talk about gas, they're usually talking about the front month futures. So they'll say, you know, gas prices are, you know, 250 million BTUs or 3, or they've gone up 25, percent in the last month, whatever. They're always talking about the front month futures. But if you're a trader in the futures market, that's extraordinarily important, right? But if you're buying and selling the producer stocks, so companies like Expand Energy, like EQT, you really care more about the price of oil further in the future, or the price of natural gas in forward months. Obviously, a company isn't going to sell all their gas in the month of November. They're not going to sell all their gas in the month of December. They're going to sell some of their production every month of the year. And most of them hedge their production months, even more than a year ahead of time. Expand Energy, the ex-Chesapeake, has, more than half their production hedged even in the first quarter of next year. So you've got, so it's important to consider gas prices, not just the front month. Don't focus solely on the front month, but also like what it looks like in the future. So if you look at this chart, you'll see that this is actually the price of gas for delivery in every month from November 2024, that's the current month, front month, all the way out through November of 2029. So I'm taking this out 5 full years. And what you can see here is that the current price of gas is really depressed.
Yeah.
But early next year, we're supposed to be back up when demand is relatively high in January, February, the highest of the year, right? You're seeing prices up in that $330 to $350 range, right? Prices come down seasonally a little bit into the summer months. That's normal, but it's still just around 3, which is a lot higher than it was at times last summer, right? But look at what happens when we look out into early 2026 or 2027 or 2028. You're seeing prices averaging 375, 4 through the course of the whole year. Yeah. So, and even 4+ in some cases. Some of those, January, February months are up around 430, 440, 450. So a company that is looking that can produce profitably at, say, like Expand Energy at under 3, say, let's call it across all their acreage, say 275, right? They're not making any money now on at least some of they're not making a lot of free cash flow selling gas at current prices. But the fact is they aren't selling gas at current prices because they hedged their production for the fourth quarter of this year, most of their production many months ago when prices were much higher. They were over 3.
Oh,
right?
Yeah. Okay.
And if they're looking out to middle of next year, they're not looking at 250. They're looking at, 350 or 4.
Yeah.
And they're minting free cash flow at those prices, especially on their Appalachian acreage, which is a much higher or is a much lower cost, much higher free cash flow at lower gas prices. So I think it's important to understand, what's causing this shift. And some of it is prices are depressed right now because of excess storage, because of that warm winter we had, because of an oversupply in storage relative to the 5-year average. But we're looking ahead to 2025. There's a big shift coming down the pike, which is that we have a number of new liquefied natural gas export terminals here in the United States due for startup. Golden Pass, right, in Texas. Expansions of several existing facilities. And as those plants come online, start filling up with gas and start exporting gas to Asia, to Europe, all over, right? That's a new source of demand. Prices are going to have to be higher to incentive enough supply to meet that demand over the intermediate to long term. And how I look at that is that the Haynesville Shale is in Louisiana. Most of the export terminals in the U.S. are on the U.S. Gulf Coast, right?
Yeah.
So Louisiana and Texas Gulf Coast. I think that Haynesville is going to be a key source of feedstock for U.S. LNG exports. So the cost of producing gas in the Haynesville is very important to the longer term equilibrium price of natural gas in the U.S. because we have all these new terminals coming online. U.S. gas exports are scheduled to go up 30-40% by the end of the decade because of these new terminals coming online. Gas is going to have to be comfortably above the break-even costs in the Haynesville, which are for the better producers in that low to mid $3 range. So I think you're going to have to see prices average over the course of a year, around 4 or higher longer term, to incent enough gas production to meet that export demand. So I think that you're going to have a lot of volatility in gas prices this winter based on the weather. But over the intermediate to long term, you've got very disciplined producers, you've got normalizing storage, and you've got a big source of demand growth coming for export and for demand domestically. This has been a story that many of you have probably read on the news lately, which is that that the data center demand, the AI, the artificial intelligence demand for electricity is exploding, right? Gas is going to have to be part of that mix, meeting that demand growth. And so I think domestic demand for gas could grow a lot faster than some are penciling in. So the idea that gas demand in the U.S. is going to be flat or down for domestic consumption over the next 5 years, I think is ludicrous. Where are you going to get the power for all these these data centers? In the short term, you're going to have a lot of swings in gas. I think that if you focus on those higher quality gas producers, I think I think that's a good place to be over the next 6 to 12 to 18 months. As gas prices, as you saw on that curve, are already much higher for delivery next summer or next winter 2025, 2026, than they are today or this winter. And companies are already hedging at those prices. So you look at a name like Expand Energy, a big producer, the old Chesapeake, a big producer in both the Haynesville and the Marcellus, just completed the acquisition of Southwestern beginning of this month, beginning of October, which gives them more exposure to both the Haynesville and the Marcellus, largest natural gas producer in the United States now. I think that's a great name to own over the next few years. Look at a name like EQT. They bought their midstream unit. They acquired their own former midstream unit, brought it in-house. They're lowering their production costs in Appalachia for that one under $2 a million BTUs. These are names that are going to produce a ton of free cash flow over the intermediate term with gas prices even in that $3.54 range, let alone if gas prices were to go higher. We're a cold winter away in Europe from gas prices spiking again, like we saw in 2022 there. At some point, I think that countries like Germany are going to start to, their energy costs are going up so much in Germany that when you think of Germany, what's the first thing you think of, right? For me, it's manufacturing, right?
Yeah, industry.
When I lived in Europe, they were the sort of, everybody looked up to them on that, their industrial manufacturing capacity. And their industrial production has been declining since 2017, mainly because their energy costs have gone up so much. Industrial consumers in Germany are paying upwards of 30 US cents a kilowatt hour, right? Which is more than double what they pay here in the United States. So in Germany, at some point, their manufacturing jobs are declining. That's been traditionally a major source of their labor market. At some point, they're going to need to bring costs down a little bit, or their entire industrial base is going to be basically eviscerated. I mean, I can't put too strong a word on that. And so I think that they are going to need more natural gas over the intermediate term. And I think the U.S. is a logical supplier. For many years, I remember going to conferences and talking about Germany, and just flagging the risk that I don't care who your main import source is, you don't want to have all your eggs in one basket. And importing 50, 60, 70, 80% of your natural gas from Russia is insane. It was only a matter of time before that blew up for them. And now obviously that's no longer possible, and they're starting to look at other sources. And I think that any importer is going to look at Germany's experience or look at Europe's experience and say, I don't want that to happen to me. So I think, US LNG exports, Australian LNG exports are going to be a major source of supply for countries like Europe, in Europe, India as well, China. So I think that the longer term, intermediate to long term future for US gas producers and gas prices is bright.
Okay, isn't there a lot of regulations right now that aren't letting Canadian and American natural gas get over to Europe and Asia? And if they lift those, all of a sudden you got a really sweet arbitrage?
Oh yeah, I mean there's lots of problems on the regulatory front. Here in the US, I mean the biggest problem flagged over the last several years has been the lack of pipeline takeaway capacity out of Appalachia, Marcellus Shale to the US Gulf Coast. So the Appalachia produces it's the world's preeminent natural gas center. Literally, it's the largest gas shale field in the United States, and it's a very low cost source of gas. The problem isn't producing more gas. The problem isn't producing gas cheaply. The problem is getting it out of there, and not enough capacity to move it down to the Gulf Coast. States like New York have refused to allow pipelines to bring gas that they desperately need into the state from Appalachia, which is right there. I
Yeah,
mean,
yeah, it's right next door.
Pennsylvania is a neighboring state. New York at times is importing liquefied natural gas, right, from overseas because they won't build a couple 100-mile pipeline from the heart of the Marcellus Shale into New York State. So the regulation is kind of nightmarish. We saw the Mountain Valley pipeline you may have heard about. The only reason that's getting built and completed and put into use is because it was included in a bill that Senator Manchin from West Virginia kind of forced down Congress's throat in exchange for his vote on a deal they needed to get done. So it's that's been a huge problem. That's one of the reasons why I like the Haynesville shale producers as the export play. Reason being is they're in Louisiana, so they don't have to transport by interstate pipeline. They don't have that capacity constraint. Obviously, Louisiana, intrastate, inside the state, the regulations are a lot easier. It's a lot easier to get permitted. They're an energy state. Same with Texas. And neighboring states, it's not as big a problem as it is from Appalachia, where you have all this local resistance and you're moving through more populous areas. So that's an issue. You have in the US, we have an LNG pause, I believe it was called, the Biden administration put in, of no new terminals being permitted for export outside the United States. In the short run, it's irrelevant because most of the terminals that are under construction or due to start construction over the next 6 to 12 months were already permitted. Okay. But starting in 2029, if that's not lifted, that could be an increasingly big issue. So yeah, there are regulatory issues. I do think that over time, it's going to become untenable to not allow more US gas exports because you're going to have Europe screaming for it. You're going to have a lot of Asian markets screaming for it. And the alternative in many cases is like coal or importing gas from places that aren't exactly friendly, right? So yeah, there are definitely regulatory issues, and you kind of have to step around those. Sometimes I think politics gets overplayed in the energy investing scheme, especially here on the US side. That's a big thing. Yeah, how many articles have I probably read in the last month over, stocks that benefit if Trump wins, stocks that benefit if there's a Harris administration? A lot of that adds up to not much, right? But and we can talk about that more specifically in a minute. But I do think that yeah, that's an issue, and I do think that over time, though, you're going to see U.S. LNG exports grow, and I think that Haynesville shale, being that it is so close to the Gulf Coast, is a key place to look.
Okay, okay. But eventually, markets work.
Eventually markets work. And, the hardest thing in the United States, particularly, I'm sure it's true in a lot of other countries as well, what's the most tangible sort of inflation for most consumers, most voters, if you will, right? It's gasoline, oil, and food, right? So if the price of those things, or in electricity, right? Things like that, energy. So if the prices of those things don't go up a lot, you're okay. You can probably get, there could be other things going on bad, but you're not going to get too badly blamed for it. Price of oil goes up 10, 20 bucks, you're out of office, right? So, I hear these people say, well, where they're going to put all these taxes on energy, or have these targets for renewable energy, and prices are going to rise as a result. You're not going to be able to get reelected with that kind of a policy over the intermediate term. And so I do think that markets work also in influencing elections. There was a German energy minister, must be about 20 years ago now, who said, we know what we want to do in terms of green energy policy, but we don't know how to do that and still get elected. And it's very true in the United States as well.
Oh, that's funny. Okay, their number one concern: how do I stay in power?
Always true.
Yes. Alrighty, Conrad wants to know, he says, which company, in your opinion, is better if you had to compare Birchcliff versus Peyto?
Okay, actually, both those names are interesting. And I think that to me, as I've said, I'm favoring a little bit more the companies that have a little lower debt, that are a little bigger, and have higher free cash flow, even at relatively low oil and gas prices, at low commodity prices. And in my mind, Peyto scores better on those models right now. So I would generally prefer Peyto. Also, to be frank, I know Peyto better because we have recommended that stock in the past in our service. But I would say that they do have the edge, because I do know that I do know both companies, and they're a little larger. Their free cash flow is held up a little better. I think their debt position is a little bit better right now. So I would go with Peyto.
Okay, if you had to pick, you'd pick Peyto.
Yeah.
All right, he wants to know your opinion on Athabasca Oil. Do you follow that one?
Yeah, I do. I do follow them. Again, a very oil levered name, of course. And in fact, they are another name that I cover, which many of your listeners may be familiar to, is called Ovintiv. Used to be called Encana. So many of our Canadian and many people watching who are more familiar with the Canadian markets probably remember it as Encana. They operate in some of the same areas as Athabasca in terms of they're in the Duvernay Shale in Western Canada. And they've had some really good success with their drilling there. So I think that's an interesting name. I like their oil leverage right now. As I said, right now, natural gas prices are very low. So I want to focus particularly on those bigger, lower cost names there. But a name like that, which is more oil levered, I think can do very well in this environment. And also, I got to applaud, again, their debt position. They've been able to get their debt down nicely. They've got some decent growth projects in the pipeline there. So I think that's a good name to own longer term. In the short run, it's going to be crazy volatile with oil, but I think over the intermediate to long term, it's a good name to own. I'd also look at Ovintiv. As I said, they have some operations in that same general area. I think the Montney Shale, which is where their business is, it's located just adjacent to the Duvernay Shale. Traditionally, it's been thought of as a gas play, and traditionally it has been a gas play, but they've had a lot of success with very liquids-rich wells in that area. And I think that's an undervalued name. They have their main operating area is the Delaware Basin, which is if you think about the Permian Basin, so you've got there's a western and an eastern side. So the eastern side is all in Texas. That's called the Midland Basin. The western side is Texas mainly and New Mexico, right? It's part of that. If you think of a map of the United States, hopefully you can see what I'm talking about. And so the western side in Texas and New Mexico is the Delaware Shale, the Delaware Basin. And it's a little bit more gassy in places, but there's also a lot of oil there, very low cost wells, very high returns. So Ovintiv has a lot of operations there. They made an acquisition there a number of years ago. That's going well. But I do actually really like some of their ancillary growth plays, one of them being in Canada, the Montney, which is a legacy of their days as Encana. So I am familiar with production in that area being, very positive. They also have the Powder River Basin here in the United States. That's another growth play for them. So that's another name I'd look at in that same area. But yeah, both those names I think are good here. And again, you're going to see volatility. But what I do with all these names is I use the same technique. I want names that can generate free cash flow with oil and gas prices near where they are right now. And I want to look at what do I think oil and gas prices are going to be average over the next few years, right? As I said, gas, I think ultimately has to get up to 4. Next year, it's not going to get there, but maybe the year after. I think oil prices over the long haul, I think penciling in $80 a barrel is probably even a little conservative. If a company with that kind of commodity deck can generate significant free cash flow, I think it's a buy. And I think you use dips in price. In our service, we have what we call dream buy prices for a lot of these things, where if the price gets down to that level, that's a good time to start accumulating. A company that can generate free cash flow through the cycle at moderate commodity prices is going to do well over the long term, regardless of what happens, over the next few months. Name like Ovintiv, it's been all over the place. But, I think if you can get it down here where it's trading right now, I think that stock could be a double in a $80 barrel oil market, near $4 million BTU gas market, based solely on discounted free cash flow valuation, which is probably the most conservative way to value. You're basically valuing a company like it's going to die in 15 years, right? So, I think it's a good value because I think that they're going to be they can generate free cash flow even at low commodity prices.
Okay. How do you follow Woodside?
Actually, my colleague Roger follows them more closely than I do. But yes, we do follow them in the service, and we have recommended them in the past. And actually, right now, it's in my colleague Roger's portion of the portfolio.
Okay. Yeah, they're about, I don't know, 70% natural gas. Is that about right?
That's right.
Okay.
Yeah.
Okay.
And again, a good export focus there. So, and I think that is I think that there's an undervalued driver of natural gas exports globally, not just in the U.S., is the energy security issue. A lot of countries are looking at what happened to Europe and saying, we don't want that to happen to us. So they're looking to diversify their exposure to exporters from all over the world, Australia, Canada, the United States, Middle East, wherever. But so that having a gas focus and an export focus, I think, is a good thing over the intermediate term.
Okay. You touched on this one. Nuclear energy and natural gas seem to be accepted as the two best options for AI data centers in general. Fiat is dead. He wants to know, he says, I'm having a hard time seeing nuclear energy generation being widespread and available for more over the next 7 to 10 years. Do you see natural gas as the dominant source of energy for the next decade?
Okay, I agree with you. Nuclear does take a while to get going. Right now, mostly the story in your developed countries is restarts, like in places like Japan, right? So nuclear plants that were taken offline following the Fukushima disaster, more than 14 years ago now. And they're now being restarted because Japan came to the realization that they have very little domestic production of anything, right? Commodity wise. And they need the energy. They can't afford not to have nuclear back online. So that's one source of demand. And here in the US, interestingly, right? 3 Mile Island. I mean, was that on anybody's bingo card, 4 or 5 years ago? Probably not. But restarting that just to meet demand from data centers solely. So I think you're going to see that over time because, one thing that data centers need, and you look at these things, the artificial intelligence, orders of magnitude more energy, but also they need dependable 24/7 energy. They don't deal well with the intermittent energy output from something like a solar or wind or um, uh, renewable energy generally. So I do think nuclear has a role to play. It does take time to build new plants. And so in the intermediate term, you're going to see in the developed world a lot of restarts and that kind of thing. And things like 3 Mile Island deal. We'll probably see more of that type of move because that's the low hanging fruit from a regulatory perspective. Developing countries, China, et cetera, you'll probably see more actual building going on there. So it will take time for that to get up to speed. I think natural gas is going to be a key source to fill in the gap. And frankly, coal is going to still have a role to play. I know a lot of people think coal is dead, but coal is still a huge source of global power. One of the things I like to remind people, because renewable energy particularly gets a lot of attention these days, in the year 2000, right, the three big fossil fuels, coal, oil, and natural gas, 84.5% of global energy use, primary energy use for all things, transportation, electricity production. 2023, last year, 81.5%, same three fuels. So 23 years, we've lost 3% of fossil fuel demand. And that's not a decline in demand outright, that's just a decline in share. Still dominant share. Last year, nuclear was about 4% of global power demand. I believe hydro was somewhere around 6. Let's call it 6. So another 10% there. But the three big fossil fuels, hydro and nuclear, you're looking at 92% of global energy demand from those 5 sources of energy. Renewables are still on the margin. I'm not saying that won't change over time. It will. But there are a lot of obstacles to that growth. One being that they're intermittent. Battery technology is still very expensive. I know a lot of people will quote you statistics saying, solar is super cheap, but look at countries that have pursued solar and wind particularly aggressively. Look at U.S. states that have pursued solar and wind particularly aggressively, and you'll see a lot of them have very high electricity costs. And that's not going to work with growth in electricity consumption like we're seeing. So I think, the answer to your question, nuclear is going to be something we're going to see, but it's going to be a bit of a wait, I think, for more rapid growth and demand on that side because of the construction timetables of these things. Natural gas is going to have to fill a big portion of that gap because of those fuels I just listed, apart from nuclear, right? It's the most environmentally friendly, certainly compared to coal, and obviously compared to oil, which isn't a particularly important electricity fuel anyway, right? It's the most environmentally friendly. It's the most widely available because of growth in production from a lot of these other countries, the U.S., Australia, Middle East as well, right? It has to play a role. I mean, I don't see another alternative. Coal is going to still fill a role in places like India, particularly, seeing very strong growth in coal demand. It's going to have to play a role. I think actually one of the slides I have here is actually kind of relevant. I think it's the 5th slide, and it looks at global primary energy demand growth, growth divided up by different sources of that energy, right? So this is global primary energy consumption growth from 2018 to 2023, broken down by source. And so I've got here on the left is the total world, right? The middle one is non-OECD. OECD stands for Organization of Economic Cooperation and Development. So that would be developed countries.
Okay.
And on the right is the world. Non-OECD would be developing countries. And on the right is the world excluding Europe. Europe is the only region of the world that over the last 5 years has seen a decline in energy demand. The only region of the world is Europe that's seeing declining primary energy demand. Every other region of the world is seeing growth. It's a matter of how much. And if you look at that, you'll see that 2/3 of developing world energy demand growth over the last 5 years has been satisfied by those 3 fossil fuels I mentioned, oil, gas, and coal.
Yeah, the three
So
bottom ones here. Yeah.
yeah, you look at that, and yes, renewables are playing an increasing part. And I'm not trying to say that they're a bad investment necessarily. I'm not anti-renewable in any way. Just saying that, you know, if you look at the facts, if you look at the maths of this thing, there's no way that the world is going to not rely on those three fossil fuels to enable any growth in global energy demand that we have. And energy demand and economic growth are two sides of the same coin. You can't have one without the other. The global energy demand will not grow, unless the economy grows and vice versa. If you look at that, I mean, I don't see, and particularly look at where you have, World ex-EU or non-OECD, those two right bars, if you will. I mean, you can't have, I mean, it's over half of growth, even worldwide outside the EU, is coming from those fossil fuels. Natural gas has to play a role. There's just no other way.
Yeah. Yeah. Okay. All righty. Let's see. We hit renewables. Let's move on to.
I
Let's
think
see.
I'm jumping around here a little bit.
No, that's okay. That's great. Let's see. We basically hit Fred's question. Nuclear energy is going to play a part.
Yes.
Graham basically. Let's see. I think you hit that one as well. How about coal? Curious Tiberius wants to love the name. He wants to know. Please share your thoughts on ARLP.
Actually, that's one of the only coal companies we recommend right now in our Energy and Income Advisor service. That was an interesting one. As I said, when I first started in the energy industry, it was very much out of favor back in the early 2000s. And one of the conferences I used to go to was called the National Association of Publicly Traded Partnerships. And they were these master limited partnerships. And ARLP was one of those, starting back in the late 90s. And nobody cared. I mean, there was literally like a pot of coffee and a bunch of companies sitting around a big table, and maybe like 3 or 4 Wall Street guys and me standing around talking to these CEOs. And, they were one of them. So they've been around for a long time. And back then, they were a really stable business. They were mainly selling their coal, which is thermal coal, used in power plants, to U.S. utilities under longer term contracts at relatively stable prices. In recent years, because of the closure of a lot of U.S. coal plants, coal is still a huge portion of global demand. It's shrinking in places like the U.S., but it's shrinking in favor of gas, right? Natural gas, because gas is cheaper, frankly, and more abundant, and obviously more environmentally friendly. So they've had to shift their sales abroad to less fixed contracts. So they do lock in prices for a period of time, but it's not the kind of longer term contracts they did 20 years ago when I started looking at this thing. So their dividend or distribution is going to be more volatile than it used to be. As I said, I think that, demand from overseas for coal is going to be strong. The U.S. is kind of the Saudi Arabia of coal, really. We have a lot of it in different basins around the U.S., places like Wyoming, Illinois Basin, also, of course, Appalachia. I think that they're going to be able to sell that coal on global markets. Their pricing is going to be a little bit more volatile than it used to be, but it's still a name we like. A few years back, I can't remember what year it was. Master limited partnerships are a combination of a limited partner and a general partner. And it used to be the general partner gets a fee for managing the assets of the limited partner. But a few years back, ARLP bought its general partner and brought it in-house. So that actually eliminated some costs for them. That also helps. At current coal prices, they are covering their distribution right now. I actually think that stock is probably priced in somewhat of a distribution cut over the intermediate term because of the volatility of coal prices and because their distribution currently is pretty high. But I think that's a great name to play coal. In fact, it's the only pure coal name we have in the portfolio right now. It does offer a nice yield, which if you want to play coal, I think that's a good way to do it, having that yield. And incidentally, as an ancillary, that same group of stocks as limited partners or MLPs, I think that's a valid way to play oil and gas as well. A lot of them are midstream companies, so they own pipelines, terminals, storage facilities. They don't produce and sell gas and oil, so they're less volatile, but they still benefit from increased volume of gas. So look at a name like Enterprise Products Partners. These all have nice yields as well. So that actually brings up a good point. Don't forget the midstream. A lot of those names we like. In ARLP's case, it's that same structure. It's not a midstream company, but that's a name we like a lot to play coal. And you get that really nice yield. It's a little more aggressive, but it's a really nice yield. Good play on coal.
Okay. All right. Yeah, they got a really nice dividend. Do you follow met coal at all, or do you pretty much just stick to thermal?
A little bit. We don't follow it as closely because it's not really an energy
An energy one. Yeah.
business per se. My colleague, I know, Roger Conrad, follows it more closely than I do, because he follows some of those Asian, met coal is used in steel making, so it's more relevant if you're following the emerging market. So unfortunately I don't follow that as closely.
Okay. Jason's got a follow-up question then on thermal. He says,
Mhm.
what is your short and long-term outlook for thermal coal? And what happens to the market when the U.S. starts exporting significantly more LNG?
Yeah, I do think, I think that coal is going to remain, even the U.S. exporting more liquefied natural gas is going to be extremely helpful for places like Europe, where politically it's very difficult for them to grow coal production or grow coal consumption and still even credibly have environmental goals, right? So I think you're going to see the U.S. LNG kind of fill in that market. What we've seen in Germany in recent years, for example, is when power prices have spiked, when their gas imports were interrupted from Russia, they relied on coal imports to kind of fill that gap. And you're going to continue to see that from time to time. But U.S. LNG longer term, I think, will fill that market primarily. Still some, but primarily that's going to be okay. But you still have incredible growth from places like India. And India cannot afford. I mean, Indian economy, I don't think people realize that, but the Indian economy has been growing faster than the Chinese economy in the last 5 to 7 years. And they're making great strides. They've had a lot of challenges traditionally in terms of infrastructure, in terms of regulatory burdens and red tape. But the economy is growing very rapidly. It's a poor country, developing country, fairly poor country. They can't afford to pay what Germany pays for electricity prices. Nobody would be able to have electricity. The country is focused on development, and coal has to be a part of that mix. Has to be. So I think a lot of these thermal coal exports that might be going to Europe now are just going to get absorbed by countries like India, which are still going to have to rely on coal for years to come. The idea that we can phase out coal, which you hear virtually every year at the COP conferences, the climate change conference from the UN every year, it's just untenable. A country like India is not going to be able to phase out coal anytime soon. So yeah, I think you're going to see coal prices are going to be more volatile than they have been traditionally. Again, companies like ARLP are not going to be able to sign these long-term deals like they used to, but the demand is there. It's just going to shift. And I think you're going to see countries like India, developing countries in other parts of the world fill that breach in terms of demand. US, Europe, less coal, for sure. I just the other day, I don't know, maybe a week ago, you might have seen this story. The UK, the United Kingdom, closed down their last coal-fired power plant, right? Go and look at UK electricity. I didn't put up a chart of this. I should have probably, but go and look at UK electricity prices. And they're the highest in the world to industrial consumers of any major country. Closing coal plants causes a large increase in electricity prices and energy costs. It might be okay for a developed country. It really isn't, but it might be okay-ish for a developing country that's seeing declining demand for energy overall. But a country like India, where energy demand is growing at an accelerating pace, a few years ago they were using 3 million barrels of oil a day, now 5.5. Um, you know, there's no way they can countenance electricity prices as high as a place like the UK. So the idea that a lot of these countries are going to follow the lead of the developed world by shutting down coal capacity, it's ludicrous. It's just not going to happen. And even countries like China that are going to talk about their renewable energy growth, they still get most of their power from coal. And it's going to be that way for a long time to come. And so I think the demand is going to be there. I just think you can expect more price volatility, but the demand is going to be there. And US LNG is going to be part of the mix as well. I tend to look at, and sometimes it feels like a bit of a cop out, but I feel like energy, you have to pursue an all of the above strategy. You can't say we're going to solve our energy needs with solar or wind or hydro or nuclear or natural gas. You have to say we're going to have to encompass all of these things into our mix. Being over reliant on one source of power is a real problem, as Europe found out the hard way, right? And so I think you're going to see these countries like India, like China, and also developed countries pursue, natural gas, nuclear, some of them less so coal, but certainly developing countries, coal too. It just has to be that way. You can't look at that chart we just showed you a while ago about the growth in power, primary energy demand, where it's coming from, and not think that all of those sources, all of those fuel sources are going to have a role to play.
Yeah, we can't expect a third world country to come
No.
up and just instantly go to nuclear. They got to come up the way everyone else did, and they go
Yeah.
coal and then natural gas, and then they move on. Okay.
I mean, I'll give you an example. In China in 2003, they consumed about 2 barrels of oil per person per year, right? In the US, we consume 20 barrels of oil per person per year. And over time, right, we've seen it with all these countries, Japan, South Korea, now China, now India, following the same pattern. That oil consumption is going to go from 1 to 2 barrels of oil per person per year to at least 10 to 15, right, per capita. And that's per capita. So the size of the population we're talking about is huge. Just as they reach a certain level of development, people are going to want the same kind of conveniences as they get richer as we have in the Western world and in the developed world. They're going to want a car. They're going to want transportation. They're going to want electricity in their homes. In India, a lot of places, rural places particularly, they still burn wood to produce heat to cook. And the government's trying to make natural gas more available, and propane, particularly natural gas liquids, more available to meet that demand. You can't expect them to follow a different development path than every other country in the world has.
Yeah, yeah. Okay, wrapping up, last question here. We've got the election coming up here in less than a month.
Yes.
Uh, we're commodity investors, and depending on the political landscape, we have to maybe adjust our bets.
Mhm.
What adjustments do you see we should make if Team Blue wins, and what adjustments should we make if Team Red wins?
Okay. Well, I'm going to start out with kind of a caveat, if you will, which is that I remember back in 2016, it was Hillary Clinton versus Donald Trump, for those of you who don't remember or don't follow US markets that closely. But a lot of articles out there saying if Hillary Clinton wins, it's going to be very bad for um, fossil fuel producers and very good for alternative energy. If Donald Trump wins, it's going to be very good for fossil fuels, very bad for alternative energy. Donald Trump won, if you don't know. And during his term, energy was one of the worst performing sectors in the S. It was the worst performing sector in the S&P. Oil prices were down, stocks did not perform well. Alternative energy companies performed outstandingly well. It was one of their best 4-year stretches in history. Fast forward 2020, Joe Biden, Donald Trump, same predictions, right, out there all over the place. What's happened under Biden? Oil prices and traditional energy companies have been the top performing sector in the S&P 500, even beating tech. Okay. And alternative energy companies have been generally terrible. So you you can't just say, if this happens, then these companies are going to perform. It's not that simple. It depends on so many, one reason it depends on so many other factors. Look, I'm from DC. I grew up in that area in Northern Virginia. And I can tell you that a lot of what happens in Washington isn't who's president, it's who is in charge of various regulatory agencies. It's a lot of behind the scenes. I hesitate to use the term, but deep state, if you will, right? Sort of the regulatory state, however you want to phrase it. And that it does change, obviously, from administration to administration, but a lot goes on that's behind the scenes, not widely watched by the public, that's more impactful, okay, than who's in the Oval Office. It also depends upon who controls Congress. If you have a Harris administration and a Republican Congress or a Republican House or a Republican Senate, it's a very different thing than if you have a clean sweep. So there are factors like that. There are also factors like we talked about earlier. If you have a Democratic administration, but their policies are seen as causing the price of oil to go up, midterms are going to be a problem, right? And they happen every 2 years, right? Or in between the presidential elections happen every 2 years. I think that politics is often overplayed in our business. I'm not going to lie to you. I think that if you surveyed people in the energy industry, at least the people I know and talk to, you probably overwhelmingly see most of them would support a Republican administration. I think that's fair to say. I'm not trying to dive into politics too much, but I think that's fair to say. I think that some things like, for example, the LNG pause on new permitting of LNG export facilities is likely to be lifted on day one or soon thereafter under a Trump administration. Ironically, some things like pipeline approvals actually got harder under Trump because you had a very well-funded opposition to every pipeline, right? So you had all these environmental groups all funded by, Democratic or left-leaning organizations fighting in the court system every single pipeline that was up for federal approval during the Trump administration. Under Obama, we actually had more pipelines approved because those organizations stepped aside and allowed the Obama administration, seen as more environmentally friendly to these groups, kind of do whatever it wanted. It was kind of a fig leaf, if you will, for the industry. I think some things have become a little easier under the Trump administration, but I don't see it being a huge driver of oil prices or gas prices or really energy stocks over the next 6 to 12 months. I see it being, if anything, more of a rhetorical or sentiment thing, and kind of over an intermediate to longer term perspective. And again, a lot of it depends on not who's in the Oval Office, but what does the government look like? Is it a split government? Where are energy prices? Because, whether it's a Republican or Democrat administration, you're going to have, if prices are high, you're going to have them take steps to try to be seen as lowering energy prices. So I think it's a little overplayed, and I don't really think it matters as much to the industry as a whole. It's more of a company by company thing, and some things on the margin like that LNG permitting pause.
Okay. All righty. Very dependent. Yeah, you got three the House, the Senate, the president. The president's only one of those three spokes, so
Yeah.
maybe not as big of an impact as the news would make it out to be.
No, he
Elliot,
gets all the
thank you.
TV time, but not not all the power.
Yes, yes.
He or she gets all the TV time and not all the power.
Yeah, yeah. Elliot, thank you very much for coming on the show. If someone wants to follow your work, sign up for your service, what can they expect if they follow you and your work?
Oh, well, Energy and Income Advisor is our energyandincomeadvisor.com, as you mentioned, is our energy focused service. We put out a new issue at least once every month, often more than that. We have model portfolios of energy companies that we follow and recommend, one aimed at more growth oriented investors, one aimed more for income. We cover the gamut, everything from renewable power to coal, right? Everything. And we have a model portfolio of specific recommendations. So that's our most comprehensive coverage of the energy market. I do have on Substack, I have a service called Free Market Speculator. which is much of that commentary is actually free of charge. I put a lot of energy content up there, talk about latest developments in the oil market. I have a recent article up there about natural gas as well. So you can go to Free Market Speculator at substack.com and sign up there to get the emails for free. They come out about once every week. And again, that's entirely free. Do have a subscription component to it, but much of the broader energy commentary is entirely free.
Awesome. I will put links down in the notes below. Elliott, this was a pleasure. We got to do it again. We should probably go a little more often because this is the longest interview I've done in probably 3 years.
Oh, sorry about that. I can't stop me once I get going.
No, this was fantastic. I love it. I love it. Yes. Thank you very much. You have a great rest of the day, sir.
Thanks for having me.
Yes. And thank you for tuning in. Be sure to support the show and share this with anyone that you think needs to hear it. It's probably your buddy that can't stop talking about tech stocks. You have yourself a great rest of the day, and we will talk to you next time.